Hello everyone, this is Jimmy Singh, broker owner of Supermax Realty. Welcome to my channel Real Estate Edge with Jimmy Singh. In today's video, I like to talk about affordability of housing in Canada. So what has happened in last 20 years to make houses so much unaffordable? I would like to share some data with you guys and also give you my opinion that the recent hikes in last year or so, would that make house affordable for average working family in Canada? So I will give you my comments after sharing the data. So folks, here it shows average household income required to buy an average home in Canada. So as you can see, in 1980s, it was 2 times the family income that can get you in your house. And then in 1990s, the income required to buy an average house in Canada was 3 to 4 times. In 2000s, it was 4 to 5 times your family income to buy an average home in Canada. And if you see in 2022, we are looking around 7 to 8 times your family income to purchase a house in Canada. But the biggest disconnect, folks, is the bank only gives you 4 to 4 times your income. That is the maximum mortgage you can get in the market. And if I talk about Greater Toronto area, the numbers look really, unaffordable. So if you see in 2020, average household income has to be 7 times to purchase an average home in Greater Toronto area. In 2022, you need 8 to 12 times, and in some neighborhoods, you need as much as 15 times your income to buy a house in Greater Toronto area. So folks, it is not the relative size of the mortgage that is the concern or the cause of unaffordability. It is the percentage you spend on your housing cost. So whatever money you're bringing, how much you're spending, that is the reason of the cost. The other big issue I see in Canada is our average income growth. So I have checked, some data online. I don't have the current data for 2022 or 2023. So I found some in Canada. If I take last 20 years, and the average income growth was 2%. So if you're making, let's say, $100,000 in 2000, in 2022, it will be just $150,000. Versus if, let's say, you are in America, where, let's say, your income grew 5% per annum for last 20 years. So from 100,000, you will be making 265,000 US dollars, which is a big difference. The government, for whatever reason in Canada, they don't want to increase the wages. They just want more new students to come here, do jobs, but not pay them higher wages. And they just want to keep the wages constant. That is the challenge. If families can't make good income, how can they afford these kind of houses? See, this is a detached medium home price in Greater Toronto area. For a detached house, 1.07 million. You need a household income, folks, $214,000 to afford it. A townhouse, $840,000. You need a family income of $167,000. For apartments, average $740,000, and for that you need an income of $148,000. So the question arises, like, how can a family afford to buy $1 million house with $100,000 income? It is not possible. And I keep talking about this in other videos as well. Yes, there's a lot of frustration on part of buyers, but a lot of global cities, big cities, whether you go to Shanghai, Paris, New York, Bombay in India, a lot of people, incomes are not sufficient enough, right? The wages has to catch up. So what I see in current environment is, maybe for next few years, the way things are looking, some parts of Canada won't see the price growth, or once they find the bottom, they will remain flat for next couple of years. I feel like bigger cities, they will bounce back eventually for the pricing. The reason is because of the population growth plus lack of supply, whereby the small towns I see headwinds because there was no substantial population growth in certain small towns. It just during pandemic, people just went there, and now they just want to cash out, move to the bigger cities because all those were temporary. Another thing I like to talk about is I don't believe that by raising interest again and again you can tame the inflation. If that is the case, you look at last 10 years, inflation was really low, interest rates were also very, very low. So what happened during pandemic was pretty much everything was shut down, and then was surplus, stimulus money provided, and people were sitting home, and then businesses were closed. So they start spending money on housing because people felt the need to have a bigger space, and also because of the government mandates to create some kind of space. And even in early January 2023, when I'm recording this video, a lot of parts of China are still closed, and recent protests and everything in China, they are making the government to reconsider their decision to open up. So all the factories, if they were closed for 2 years, if let's say for housing, the lumber prices went up, but they are down now. Inflation is still up. If you see, car prices, now they're coming down, but in last 2 years, because of the shortage of semiconductors, even, some other energy, if I talk about gas, prices they also skyrocket because all the refineries, all the people available to work, they were not working, they're just sitting home getting government money. So all these things, I think if you put all of this together, you can see the sudden bump in house prices, which are artificial, and now we are moving towards stabilization. And if I talk about people saying people gonna just lose their houses and delinquency rates are going to go high, I doubt, because Ontario has a delinquency rate or mortgage default rate sitting around 0.1%. And what I found out in recent study done by Equifax and CMHC is people who own assets, meaning they have mortgage, those people are less susceptible to default versus people who don't have a mortgage. There were some stats, you can Google it and find it. So they said in the third quarter of 2022, delinquency rate or default rate for the people who have mortgages, they have 0.3% defaults on auto loans. On line of credits, the default rate was 0.2%. On credit cards, the default rate was 0.5%. Versus consumers which didn't have mortgages, their auto loan default was 3%. Line of credit default was 0.6 to 7%, and credit Visa cards default rate was 1.75%. So all I want to see is the people who have assets, they have equity in the properties, they can absorb the cash flow challenges, and the people without assets, they can be in challenging situation if they lose the job. So that is the reason of them defaulting on some consumer debts. This is the reason in last few weeks you probably have heard news about Office looking into underwriting policy, where we have stress test on mortgages. Now they are considering stress test on consumer debts also. So I don't see the interest rate in 2023 going further up to 7, 8, 9% as some people are saying. Maybe by end of this month in January, we will have a quarter point hike. Maybe again in March, push come to shove 0.25. But all in all, it's going to be high rate environment this year. And next year, they will probably start decreasing a bit, not too much. And long term, for the next few years, I can easily see rates hovering around 3 to 4%, unless we are heading to a big recession where people start losing jobs. And of course, government also has a lot of debts to pay off. So, they will maybe start cutting that time. But beyond 6 months, folks, it's very hard for any professional to predict. I personally feel the first quarter sales will be down. Second quarter, we will stabilize with the interest rate. So the consumer confidence will come back, and the people, especially whose mortgages are coming for renewal from private lenders, they are the ones who might be in trouble. And since they can't seek financing from, A plus lenders or B lenders, they might have no option but to either sell their properties or go power of sale. And lastly, all I want to say is don't read too much into media headlines, or sometimes we see some headlines saying default rate is double. So let's say in Ontario, the default rate for mortgages is 0.1%. So if it doubles, it means it is 0.2%. Still, it's not a lot. If you compare this default rate to financial crisis in US, when mortgage default was 10%, 10, whereby in Ontario right now it is 0.1%. Another thing is sometimes people share pictures. These houses, luxury houses, are going power of sales. I see some tweets last few weeks. Most of those houses, folks, people were either flippers or building new homes, and they have 4, 5, 6 mortgages on the properties, private money. And now private mortgages, the people who lend them money, they probably borrowed from their own line of credits which were cheap, and now they see their own carrying costs go up, and they said, sorry, we can't renew your mortgages. So those are the more people I'm concerned about. I'm not mostly concerned about immigrants or normal people. They will do their best to save their property. And I also talk about in some older videos that bank is not there to take your house away. They are willing to work with you provided you give them a logical answer or explain your situation. They can either stretch your amortization or work with you to make some kind of payment arrangements. So don't read too much into negativity, folks. Just focus on your financial part every month. See your cash flow and stay safe. Talk to you again. This is Jimmy Singh, broker owner for Supermax Realty. You can reach me at 647-961-2639. Thanks for watching.